So, guys, I'm Matt Faircloth. I'm one of the best ever CRE hosts, along here with Pascal Wagner, who is also a best ever CRE host. We're going to be talking tonight. Again, my man Samarth talked about my book, Raising Private Capital. And what I like about this tonight's training is it's really about the other side of raising private capital. This Pascal is like being private capital. This is the journey of a passive investor that wants to get involved in a operation and have their money grow for them through the efforts of another. But how do you do it? There's a lot of certainly bad decisions you could make, and that. So we're going to get tonight into a phenomenal roadmap that Pascal's been able to put together for himself and his students about passive investing and how it works. So without further ado, let's get to Pascal. But I want to just a few notes for everyone. Please post your questions into the live stream chat bar. So post your questions there if you have questions for Pascal. He and I will get to them at the very end of the presentation. So stick around to the end and we'll make sure that all your questions get answered. And Pascal has already promised he'll stick around until everyone's got all their questions answered. So I'm sure today's presentation will drum up a lot of questions, but we'll make sure you guys get covered. So let's type them in and we'll make sure that they get handled at the end of the presentation and that. So Pascal, I'm going to go ahead and hand it over to you, man. Thank you so much for putting together the hard work for tonight's presentation. Appreciate you taking in your time to educate all of us tonight. I'm looking forward to hearing what you have to say. So with that, I'm going to go ahead and go on mute and turn my camera off, and I'll hand it over to you. All right?
I appreciate that. Thank you for the incredible intro, Matt. Welcome, everyone. Hi, as Matt mentioned, I'm one of the rotating hosts on the best ever CRE podcast called The Passive Income Playbook with Pascal. And today I'm going to show you how I've built a six-figure passive income portfolio and how you can basically apply all of the same principles, even if you're starting from scratch to do the same. So whether you're managing your own investments or you're just trying to figure out who to trust in this space, I think this presentation will help a little bit. So a quick note before we get started. I am not your financial advisor. I am just sharing what's worked for me. So whenever you're considering investment, do your own research, get a secondary opinion. My goal is to help make you a little bit more informed, confident investor with this presentation. So just to make sure we're all in the right place, this is for you if you've made a few LP investments or you've thought about it. Or maybe you're still not confident when deals hit your inbox. Maybe you have money, but you have no system for figuring out what's right for you. Maybe you're reading the books, you're listening to the podcasts, you're in the different communities, like the best ever community. But deep down, you're still asking yourself with every deal that comes across your door, is this right for me? And so my focus is helping you get off of that roller coaster. And I'm not here to sell you any single strategy. My goal here is to help you think like a portfolio manager. It's to help you make fewer mistakes, build a system, and create real income. So my promise to you, what you'll walk away with today is the exact 3-step system that I use to vet any passive deal before I wire a dollar. So this includes how I spot red flags that most investors miss, how I filter deals based on my actual goals, and why even experienced LPs lose money and how I avoid those same mistakes. And this is a framework I built over the years, managing and deploying over $150 million and evaluating over 2,000 opportunities at one of my last firms. And now it powers the portfolio that pays me monthly today. First, a little bit of a backstory. So, I bought my first property in Austin with a friend when I was 23. And we had no idea what we were doing. We were just trying to get in the game. And over time, I picked up more rentals. I learned how to manage tenants, deal with leaky toilets, and juggle mortgages. And back then, I didn't really even know the passive real estate investing existed. I thought owning rentals was the only path. And frankly, I wasn't accredited. I didn't qualify for these private deals. And so I had to build everything from the ground up. Over the years, I scaled to over 11 properties in Atlanta. And, on paper, it looks great. I'm making double-digit returns. I have solid equity growth, but it is still active work. I have a property manager, and I'm largely hands off, but I'm still the asset manager. I still manage people. I still do insurance. I still have to do taxes, and I have to get in the weeds when I need to. So along this journey, I think what's important to share is I joined a venture capital firm called Techstars, which is where I've kind of reviewed over thousands of startups, interviewed hundreds of founders, and deployed that $150 million into over 300 companies in a 3-year period. And I didn't go off instinct. I used different filters and scorecards and frameworks. And it's at that firm where I really started to learn how institutions think and understand, what's the real risk and who's behind this and what does the structure make sense. And all of that's kind of influenced what I'm teaching you here today. And just to double click on that, at Techstars, it was literally my job. I was brought in to figure out how to find all the companies in our network and then put them through a filter. I built scorecards, I ran diligence calls, I created systems, and it trained me to evaluate deals objectively and not emotionally. And even though startups and real estate are different asset classes, the principles are the same. Track record, risk profile, and alignment between structure and outcome, like incentives. So then while I was there in 2021, my dad passed away, and suddenly I was responsible for my mom's entire financial future. She's 65 years old. She inherited a multi-million-dollar portfolio, but it was all in cash and stocks, and there was no plan, no income, and it was just moving up by hundreds of thousands of dollars every day. So I did what I knew at that time, which was move a bunch of that money into my existing co-living portfolio that I knew was kind of already working for me, so I could provide her an income so we weren't just eating away at the principal. And that said, after I kind of deployed a lot of that money, I knew I couldn't have everything riding on one strategy or just me as an operator, and I needed diversification and something that I felt comfortable supporting my mom. And that's when I became obsessed with passive investing. So, I suddenly then had to manage this portfolio, and I did what most people do, which is I called financial advisors. And they handed me mutual funds and ETFs and, things that might grow, but they weren't designed to make income. And I'm sitting there and I'm thinking to myself, like, how is this going to help my mom pay the bills and not just make her nest egg go away? And so that's when I really became obsessed with cash flow. And I didn't want growth someday. I wanted. So, I think from there, I just realized Wall Street didn't have the answers. And so I went deep down the rabbit hole and spoke with different mentors and masterminds and did research, like you name it. I leaned into my mentors at GoBundance, which is a men's mastermind group where, a tribe of healthy, wealthy, performing men. And there were people there that were living off of the money that they had invested in funds. And they were collecting checks from investments that they understood, and they had portfolios that actually paid them monthly. And that's when I leaned in and, I tried to figure out everything that I could. I started going to conferences. I started different mastermind groups, investor meetups. And then every investor I met, I asked the same 3 questions. How do you choose your deals? What do you look for in an operator? What's actually working and what's just marketing fluff? And once I had a foundation, I started investing. I tried many different asset classes for one reason or another. I started doing hard money loans with my buddies to an individual investor in 2018. Probably the most riskiest thing you could start with. And then I moved up. I invested in retail and oil and gas and multifamily and self-storage and development. And I learned a lot, both from what worked and what didn't. Here on the screen are a couple of those investments that just show those returns. And out of everything that I tried, later debt funds are kind of what stood out. They they offered consistent monthly income and low volatility and built-in downside protection. And I started seeing, $500, $1,200, $3,700 hitting my account every month. And that's when I realized, like, this is what passive income is supposed to feel like. I practice what I preach. So today I've invested in over $3.4 million personally across 23 different deals. Some were great, some not so much. I've learned the hard way that diversifying blindly doesn't really protect you. And, at the time, I thought I had a plan, and I did somewhat, but, looking back, I was really just guessing compared to what I know now. And, like I said, not everything worked out. I had operators disappear. I've had, deals miss projections, delay K1s. I lost money on a deal that looked amazing on the surface, and one of them paid 12% monthly until it didn't anymore. And so that's when it hit me. It's just because something sounds good doesn't mean it's safe. Despite that, I kept refining my approach, and I eventually did figure it out. Today, my portfolio pays me over $100K a year, or my family $100K a year. Here you can see 2023 and 2024. This is a portion of what supports our family's lifestyle and gives us the freedom to pursue other things. And so I didn't get here by chasing higher IRRs. I had to learn how to evaluate deals differently. So that's why I created the firm I have today. So just as some context, I wanted to help people shortcut that learning curve because no one teaches you how to be an LP and how to do real due diligence. And so I'm building this firm to help give people that roadmap I wish I had. And that starts by shifting one core belief. So what I've learned over time is that most people blame the deal or the market or the operator, but those aren't really the root cause. The truth is, they just didn't understand how to evaluate risk. Every investment feels like a gamble because there was no consistent way to say yes or no. So I used to pick deals based on a little bit on IRR, a track record, and gut feel before I got my system in place. But I knew that it lacked a comprehensive strategy like I had when I filtered deal flow at Techstars. Every pitch looks amazing. I'm sure you've seen tons of deals that look amazing. And the reason why a lot of us, myself included, lose money, or at least I did in the beginning, is because I didn't have a good filter and a good process. The challenge isn't finding deals, it's learning how to filter them. And so without a framework, it's impossible to know, is this the right operator? Does this match my goals? What's missing from this deck? And so I want to show you exactly what changed for me, because before I had a system, I was second guessing every deal. I've read the pitch decks, I looked at the IRRs, and maybe a friend would send me an email and I'd look at their deals. And once I had a filter, I stopped wasting time and I instantly knew what to say yes to. And so the change was that my portfolio started working for me instead of stressing me out. And now I want to show you how that works. So this is the full framework that I use before every investment. And if you get this right and you follow these steps, you will move faster and make fewer mistakes. I call it the buy box, and it's broken into 3 essential parts. And we're going to start here with step 1. Okay, so step 1 is all about getting aligned. Are you trying to replace your income, build long-term wealth, or minimize your taxes? Those are pretty much the only 3 things that you can really gear towards. And each of these has a different risk profile. If you don't know what problem you're solving for, how do you know if it's So I learned this from Robert Helms and Russell Gray, the real estate guys, early on in my journey. And they told me and shared that you're either investing to grow your net worth or basically to pay yourself in cash flow. One's not better than the other, but you're not going to be successful if you're optimizing for both at the same time. And even if you're trying to, go into a deal because of the tax benefits, ultimately you're still just trying to either grow your equity or earn cash flow. And if you don't define this up front, you'll chase the wrong deals. This is from my own experience. I put $100,000 into a fund with Grant Cardone, which promised strong IRR and great upside. But the monthly income is awful, right? It's a 1% cash on cash return. And, around that same time, I invested $100,000 into the DLP lending fund, which has a lower IRR, but, basically it's distributing every single month. And that has a significantly higher monthly payout at $833 a month. And so, I learned a lot about the structure of the deal kind of determines what I get. And I've stopped chasing projections and starting to align my investments with what is it that I want out of it. What am I trying to go for? Early on, I didn't know what problem I was solving for, and that's why I kept second guessing myself. So, I want monthly income, and so now I look for cash on cash returns. And I want to know, are they paying immediately or do I have to wait a couple of years? If I'm focused on growing my wealth, and I have a long timeline and I'm working a job and I don't plan on, that changing for a while, then I care more about IRR and equity multiple. And they serve different purposes. So now every deal I look at starts with this question of what is the job I want this money to do? So once I knew what I was optimizing for, I built then a simple macro plan. So, I didn't want to just react to whatever deal landed in my inbox. I needed a GPS, a treasure map that told me where I was going and what types of assets got me there. And this step alone saved me years of wandering around and trying to figure out what to do. And anytime I've skipped it, I've regretted it. So when I got serious about replacing my income, I reverse engineered the number. I knew I needed around 1.2 million at an 8% return to make 100K a year. By putting it in a spreadsheet like this, it helps me understand what that looks like. This version I'm showing you here is a little bit more polished. But the first time I did this, it was just a rough sketch to think through the plan. And I layered in the deals based on the actual returns I'd seen and not just projections. And then once I mapped it out like this, I stopped chasing random deals. And then I actually had a real strategy, right? And this strategy could change. But at least now I have a roadmap. So to pull that together, here's what that kind of looks like for me right now. I've invested across all kinds of asset classes. Not everything is in here. But, when I looked back at what was actually paying me every month, it was just a handful of deals, mostly debt funds. And that's where kind of the real monthly income came from. And so I doubled down on what's working. And that is how I've been supporting my family without kind of being glued to a screen or managing tenants like we would in our active businesses. And then lastly, the last part of the step is once I had clarity on my income target, I could go find deals that actually matched it. Because I realized early on, just because a deal is available doesn't mean it's a fit, right? It has to match my plan. I built that process to vet operators, evaluate returns, and avoid hype. And that's what I'm going to show you now is how I filter deals so that you see how it's a system and not a guessing game. So after mapping out that broader plan, my income targets, my allocation range, my overall strategy, it's time to zoom in. You go from macro to micro. Macro is the destination, the treasure map. The micro is the vehicle that gets me there. And at this stage, I needed a filtering system and something that helps me say no to a lot of deals fast. And, a lot of LPs I've met, can build a broad plan, but then when it comes to figuring out what their buy box is, I hear crickets. So from here on out, I wanted to know exactly what to say yes to and what to ignore. So this is the tool I personally use before every deal so that I can make a rough outline or buy box. And this is, particular to passive investing. I filled this out to answer a few things. What do I actually want? Do I want cash flow? Like, what's my primary objective? Cash flow, equity growth, to reduce taxable income. When do I need the money back? What kind of operator and reporting cadence am I okay with? It's not just a worksheet, it's my filter. And once I fill it out for an individual investment, an individual, 50K or 100K slot, this is what I'm looking for. And then I could instantly eliminate 80% of deals. And that's how I stopped chasing shiny objects. And look, I think as part of this, once you have your thesis, you can start matching the right asset classes to it. If I want consistent monthly income, there are asset classes that are best designed to do that. You can start looking at debt funds and private credit. If you want appreciation, then, oil and gas is a great vehicle. Mobile home parks are a great vehicle. And if you want some cash flow and an upside and tax, if you want a little bit of all three, you can do that too. You can buy multifamily and self-storage and all these other asset classes that we all know about. And I hear often from people, it's like, oh, I don't even really know if I should be playing around in these other asset classes. And I think that's really defined by your thesis. So in addition to that, deals inside the same asset class don't all play by the same rules. And I learned that the hard way when two apartment deals I invested in had completely different outcomes. And one's stabilized and cash flowing from day one, and the other's like heavy value add, but before you start seeing a dime. And I knew those going in, but it feels different the longer you have to wait. And so, I built this grid to kind of help me match up, each deal to the stage I was in. And sometimes, if I needed stability, I know where to go. And sometimes, I'm willing to wait for upside. I've done some development deals. So, now, another thing I think to think about when you're creating your buy box or your investment thesis is, early on, I only wanted to work with big institutions. I figured if I'm trusting someone with $100,000, I'd rather pick the group with audited financials, full-time staff, like a long track record, people that have, seen multiple downturns. And for a while, that was the right move. And I think it really gave me the confidence of continuing to invest in this space. And then as I had done a little bit more deals, I started exploring smaller operators. Some of them had incredible access to niche deals and were just maybe a little less polished. And others were more flexible and, had more skin in the game. So, now I don't really pick based on size. I think a lot of it matches to the type of deal I'm doing and matching the operator to the opportunity. So I think both can work, working with someone small, like an emerging manager or more of an institution. But the key is having a plan. Like, who do you want to work with? Another blind spot I had for years was the capital stack. I think I didn't realize I was always doing the riskiest seat, owning the asset and hoping it performs. And I think, over the last 5 years, a lot of us have gotten maybe tagged if you've invested in the equity side. And, if you compare that to a lot of debt funds, some of my best returns have come from lending. So as a debt investor, I get paid first. I get paid monthly. And I found I honestly just I sleep a little bit better. And so that's kind of informed a lot of my strategy. Now, when I need consistent income, I sit on the top of the stack. I invest in a lot of debt. And then when I'm swinging for upside, then I have a portion of my portfolio that is in high risk equity. And so that's just something I think that's worked for me. I do some deals where it does, little of all three, but I think generally for passive investing, that's how I think what works best for me. And then now we're moving on to step 2. So once I had a system for evaluating deals, like we did all of the homework, the foundation, it's time to go hunting. So one of the hardest parts for me early on was I'd see something flashy, but didn't match my goals, and I was just, running around on if I should do the deal or not. And sometimes worse, I didn't even have deal flow. And so I was just waiting around for things to show up. I didn't know where to look. So I got proactive and I started reaching out to GPs, joining masterminds, asking for intros. And I basically built my own pipeline like I had to do in my venture capital days at Techstars. And so over time, that pipeline started sending me deals. Ones that were actually with my filters. And in this section, I'm going to show you exactly where I go to find those high quality opportunities. And then I'll also show you how you can shortcut a lot of the guesswork. So if you have your phone around, I would have your phone handy if you like to. I'm going to have a giveaway here in a minute. But this is where everything clicked. Once I had my thesis dialed in, I started turning it into filters. And, I wasn't just reacting to deals anymore. I had a framework to quickly say yes or no. So it's kind of like setting your GPS. Once you know where the destination is, you don't stop wandering and start driving around. And this filter view changed the game. And I stopped looking at every deal and I just started evaluating the ones that were meant for me. So my first passive investment actually was through Fundrise back in 2013. This was my entry point, and this is a great place to look for deals. It's evolved a lot since then, but a lot of these platforms play a real role. I use sites like CrowdStreet, Realty Mogul, Equity Multiple, not just to invest in, but to study deals, what's out there. They're a great way to get deal flow, especially if you're just starting out. Most of the deals I invest in now come more directly from operators or funds I have relationships with, but I'm always surprised by a unique opportunity on these platforms. I think the real value is getting reps in and seeing how different sponsors present deals and noticing patterns. And this is a great place to start. Another one is, one of the simplest ways I learned how operators think is just by reading their newsletters. I subscribe to every single one I can find. Following these showed me how they framed deals, what they emphasized, how they communicated risks, and more importantly, it gave me a front row seat to how transparent they are, and this costs nothing. You can build a lot of context over time by just taking 5 minutes and reviewing some of these emails every day. But the biggest accelerator for me was joining the right communities. So groups like GoBundance, Best Ever CRE has been a huge help. Long Angle, 506 Investors Group. There are all these different groups out there that have opened up a new layer of access and where you can really get quality thought. And suddenly it wasn't just me evaluating deals. I was learning from other LPs and comparing notes and seeing what other people invest in because they post it online. You don't need to go it alone. The right group will not only save you from bad deals, but they'll help you find better ones. And I'm not above clicking on ads. In fact, it's actually one of the easiest ways that I've found new operators. Facebook, LinkedIn, Instagram, they're all filled with sponsors from posts from people raising capital. And I am the person who sits there and clicks through them and signs up for every webinar and newsletter and see how they present themselves. And, it's not always a fit, but every once in a while I find someone who surprises me. So, I think this is about staying curious and treating every touch point as a lead source. Another one is, early on I didn't know where to look. I joined mastermind groups. I was near other LPs. I was near other fund managers. And sometimes I'd get a deal forwarded by a friend. And sometimes, someone would present to a group. And when you're in all of these different groups, you start hearing about deals long before, they're very public. And I would say don't sleep on local groups. I used to think that all the best deals are online, but a lot of these private groups have proprietary deal flow. So, I went to events like the Boulder Investment Group when I lived in Colorado. I live in Miami now. These events aren't flashy, but it's a, shake hands, meet people kind of thing. And I try to stay plugged in even if I'm investing nationally, because the local stuff just keeps me grounded. And then, when you're successful, this is what your inbox starts to look like, or at least this is what mine was. Operator newsletters, mastermind intros, local group platforms. It all started to compound, and I wasn't scrambling anymore for deals. I got more into sorting mode. And once these deals are coming to you, the question isn't where do I find something? It's more which one of these aligns with my plan. And that's where we want to be. So, but here's the point I want to make here. The reality is the best deals don't go to the smartest investor. They go to the ones who see the most. I didn't want to rely on one friend or one platform or one operator. And so I think a good investor needs to, you need to build a personal pipeline of deals. And so I positioned myself to have all the deals start coming in. I don't do this with a massive team. And now I have more options than I can keep up with. And I think that's the leverage you want as an LP when you're choosing from a menu of deals instead of chasing whatever pops into your inbox. And so this is my passive investing starter kit. You might hear me talk about this on the Best Ever podcast, on all my shows. This is the same deal, the same sheet that my team uses every week. Every single week, we get all of those emails in the inbox, like I mentioned, and I have someone on my team that takes those and organizes them into this database. And you can filter things by, do I want to invest in equity or debt? Do I want to invest in funds or syndications? Do I want to look at deals that only have monthly distributions or are only in the asset class of multifamily, as you can see here? And you can go and directly look at the decks. These are all C opportunities. If you find anything in here that's not, please let me know. I have to remove those. But, this is the deal flow I come across. It's not vetted. But, this was the number one problem I had when I started. And I imagine if you don't have a lot of deal flow, this could be a good fit for you. So as you can see, it's got over 700 deals in there. And it might be a good place to start. All right. So now we need to move into evaluating the opportunity, right? So just because a deal fits our goals on paper, we make down our short list. We go from, 500 down to 10. And, now I'm going to walk you through how I go through those 10 and how do I avoid the most common traps. This is what protects your downside and I think is what really saves you when you're starting to look at deals and helps you sleep at night. So how I will preface this section, everyone wants to know, how do you do due diligence on an operator? And I will say that due diligence is not a one-size-fits-all. It is a spectrum. On the one hand, you have the retail investor who wires funds after hearing about a deal from a friend and skimming a deck. And then there's, on the other hand, you've got family offices that do background checks, financial audits, and fly out and visit the operators and follow them for several years. Neither approach is wrong, but what matters is knowing where you land on that spectrum and building a process that reflects, what you're after and your risk tolerance and all that thing is all things you need to consider. So personally, I aim for a sweet spot where I want to have a structured enough process to catch issues, but I'm not a $50 million family office that has a big team, and I also have a lot of other things going on, and so I kind of strike that balance. So my due diligence checklist, I have a lot of people to thank. My first deals, I didn't really have a checklist. I was winging it. I was asking basic questions and hoping for the best. And every deal taught me something new. And, I've taken checklists from so many different places and now combine them all into one that works for me. And this is one that keeps evolving. It's not static. And every unexpected issue or something I overlook becomes a new question on the list. And, I'm not telling you here you need to use my exact list, although I think my list is pretty good. But you do need a checklist. And so that's honestly how I believe I made my process consistent and repeatable and resilient under pressure. So what is actually on that checklist? What am I filtering for? Okay, so this is where we're going to take all this theory and we're going to put them into very specific criteria. And instead of getting distracted by marketing materials, we're going to focus on 3 pillars: track record, execution, and transparency. So forget the pitch deck. I want to see performance. Anyone can project a 20% return. I want to know, did they actually hit it? What has been their historical nature? This is typically how debt funds report their returns. And I'm constantly asking, how consistent is it? Are they hitting their targets? If they missed, can they explain why? Are they honest? Are they burying the bad news? This I honestly think is the most objective way to judge an operator's credibility. If they overpromise and underdeliver, that's something that you can't ignore. One of the most valuable other filters I use is this: has the operator taken any deals full cycle? So if you're in multifamily, self-storage, triple net, whatever it is, if it's not like an evergreen fund and there are more syndications, I want to see the deals that have gone full cycle. I'm not giving you money to learn. I want to invest with someone who knows what they're doing and has a solid track record doing it. I really pay close attention to realized returns. And so, if they've never returned capital, maybe if they're, early in their days, everyone starts somewhere. And, they're just not starting with me. One of the other things I love looking for is the case study. I think these are great ways to really understand how their businesses work. If they don't have these, I would ask for them. And you can also ask for case studies of deals that went sideways. Like, hey, you might not have this in marketing form, but, can you talk to me about a quote unquote case study where you had a deal go sideways? The best operators will share what, in my humble experience of talking to over 200 GPs at this point in real estate alone, I will tell you that, in my opinion, the best operators walk you through the wins and the bumps and will share anything that you need. Another thing I like to pay attention to is when I evaluate a debt fund, I ask for a loan tape. This is a touchy subject in the community, but I'm going to plant the flag down. I think this is a must-have and a deal breaker. It shows every loan inside of a debt fund, how much, where it is, what the LTV is, and the interest rates. They can leave out the exact addresses or the exact clients, but I want to see what's in there. I want to know what I'm actually investing in with all the fraud and everything that's been going around. And frankly, just being in this niche enough where I know, there are so many others that provide it that it's just, if they don't share it, I pass. There are enough funds out there that provide it that it's just a risk I don't need to take. And overall, I want to see their full portfolio, past and present. So this gives me an idea of the firm in general. Well, how diversified are they? How many exits have they had? How many are active today? You're always just trying to build a picture around who it is you're working with. And I find that a lot of these documents are all about adding a data point and helping you really understand, who you're working with and the deal you're investing in. One of the newest additions is, I'm going to give praise to our friends over at Evoke. capital, they do mobile home parks. I think one of the clear signals is an operator showing their NOI growth. So, how successful were they at implementing their business plan? Kind of outside or regardless of the interest rate environment. A lot of sponsors got wrecked over the last 5 years. And arguably, you could say they should not have invested in deals, or, they should have seen the risks coming. And on the other hand, some deals have kind of gotten flat and they haven't lost investor money, but you can see that they executed on their business plan. And I think those are still deals in my book and operators in my book that are still worth talking to, because it's clear, everyone makes mistakes, and it's clear that they had executed. And, this is now something that I really look for as another data point. Another thing I really like to look for is communication. So, this can make, or as if you're new to this, or as you may know, communication can make or break your investor experience. So I want to see regular updates and key metrics and honest reporting, and, videos are great. This is, I'm invested in this deal with Rise, and, this is an update. It's a great example. They go into a lot of detail and really tell you what's going on. And, even though Rise has some deals that are struggling a little bit, I think in terms of the way that they communicate and how professional they are, and, I think at least in this area, it's a double thumbs up, and it's a great standard. This is what helps me sleep better at night. Other ones are, here's another one from DLP Capital. So this is very transparent reporting. This comes out every single month. And this is what I think the highest level of reporting is. Comprehensive, regular statements. They're, as you can see here, I think it's like 6 slides I get every month. They give you a word update. They give you a lot of new data. What loans did they buy off? Did they originate? They're literally showing their income and balance statement, every single month. And then there are some operators that won't show you any of that, right? And I think when you've become accustomed to this, it's hard to go back. Yeah, operators who are proactively delivering, this takes work, this takes time, this takes resources. Not a lot of emerging managers can do this, but, the operators who proactively deliver this level of reporting have nothing to hide. And that's exactly who I want managing my capital. Let's flip it. What makes me walk away from a deal, if they dodge basic questions, rush you, or can't name anything that goes wrong, that's a big warning sign. I trust my gut now. If something feels off, it probably is. Your goal isn't to be paranoid. It's to be clear-eyed and patient. And now we're hopping into step 3. So by now you've created a macro plan. You've filtered your deal flow. You've gone and done a couple deep dives. But but at this point, you have a good idea of what are your top 1 or 2 funds. When you go through that checklist, that gives you pretty much everything you need to know. You either feel good about every answer, or there's some red or yellow flags in there, and you decide that it's not for you. I think, but before you wire the money, there's one thing I think that experienced investors do. It's the same with passive investing as, in the venture capital world, when I was a fund manager there, they validate their conviction. And so this is where I think it's important to pause and ask, have I pressure tested my thinking, and have I compared my notes with other people who've invested? Here's one of the most important things that I do before investing. I validate the deal and by talking to people who are already in it. I'm in a bunch of different text threads and groups. I pulled one and crossed out a bunch of names for privacy. But, even if a sponsor gives me references, which of course, they'll share the happy ones, I want to go deeper. I want to ask other people, how long have you been in the fund? Where else are you invested in? How does this fit into your portfolio? Have there been any surprises or delays? Do they deliver K1s on time? And, I'm cross-referencing all that feedback with mastermind groups, WhatsApp threads, my other LP investor friends that I've made now. And the goal isn't to confirm what you want to hear, but it's to test your conviction. And you'll start seeing patterns. If multiple people start raising the same flag, it's when you pay attention. So this alone saved me from at least one deal that looked amazing on paper. So can't recommend that enough. And then the last step, I want to kind of tie this all in a bow. Once you wire the money, most LPs think they're done. And that's actually where a lot of people drop the ball. So I think your edge in LP investing is how well you track your performance and how much you prep for tax season and help you make future decisions. So I'm going to walk you through some of the lightweight systems I use after investing to kind of stay in control and keep building that momentum that I think everyone should have. So this one's maybe a little bit boring, but I think that it's one of the first things that separates pros from chaos. So every deal that I do gets its own folder in my G Drive, PPM, decks, subscription documents, wire confirmations, everything goes in here. Once it's in here, I can find any deal under 30 seconds, and at tax time or when a deal goes full cycle, it's really easy to point back. There have been so many times when I've had to try and dig through my email and try and find things and pull them out, and just once you have a basic system, it's not hard to rinse and repeat. And a lot of things I talk about is how do you build your investment portfolio like a business that supports you? And if you're investing like a business, you need a filing system like a business. And you wouldn't run a business without a dashboard. So why would you invest without one? This is one of the sheets that tracks every investment I make. I put in who the operator is. I link it with my QuickBooks, and I can pull in distributions received, and it's really easy to tell what's underperforming, what tax benefits I've gotten. And just like a real estate schedule that you might have as an active real estate investor, I have what I call my LP investment schedule, which is particularly for those investments. And I also have another kind of doc that I recreate every single year for tax time. This has saved me dozens of hours and at least one accounting meltdown. So, at tax time, I just send this to my assistant sends this to my CPA, and it lets them know, what are we expecting? Are we expecting a K1? Are we not? Is it a 1099? Are all the files uploaded? Or where do we need to log in, or who do we need to reach out to if things, aren't there? And this has changed my entire process from chaos to calm. Okay, so we've covered a lot today. You've now seen the full framework I use to build and grow a six-figure passive income portfolio. So from everything from setting goals to filtering deals and doing real due diligence, this is literally the exact system that I use that I wish I had when I was starting out. And now you have it. And so what I would emphasize here, though, is just knowing it or seeing this won't change anything for you. And what matters most is if you like this framework, how you act on it. And so I'm not showing you these tools to impress you, or, they're not very fancy, but they're the reason I don't make emotional decisions anymore, and why I sleep better during tax season, and why I've hit that 100K a year goal. And, I'm still improving, but it's not about being perfect. It's just about being consistent. And I think, if you're asking yourself, how do I build this for yourself or adopt this? I'd love to quickly just show you how you can do that. So now at this point, you might be thinking, okay, all this makes sense, but it's a lot to do alone. And everything that you've seen today, the templates, the frameworks, the worksheets, the system, everything I use to build and manage my own investments, if you want those sheets and if you want help applying it to your portfolio, that's exactly what I do inside my Cash Flow Academy. So this is not like a video course you binge. It's more like a guided system that you apply. You get a step-by-step curriculum. It's like 8 hours of video. And then the real value is in the implementation. So, you then have one-on-one calls with me, give you access to every template. And in every meeting, we kind of review what you've done and help you make sure that you go through the program and implement everything. And it's a one-on-one program. And we didn't quite expect over 400 people to sign up for this webinar. And because this program includes one-on-one support, I won't be able to work at everyone at once, depending on how many people signed up, at least not for this upcoming cohort. But I run these small groups intentionally so you can get real feedback, really bring your questions, personal questions, and implement these with clarity. It's constantly an evolving program. I take what I learned from each cohort and I iterate on the content and update the templates and improve the offer. And at some point this will shift and I may transition into something more scalable. But if you want, one-on-one, this is a good window. So if you're ready to take the next step and you want help, or even just to ask me a few questions, I'd love to chat. You can scan that QR code with your phone or go to the link below it, and you'll fill out a short application. We'll hop on a call, walk through your goals. I can answer any questions you have, and my goal is really just to help you. Everything will be done first come, first serve, and I expect them to go quickly. With that, thank you very much.